All right, let's talk more about what moved the markets today. We're joined now by Charlie Bobrinskoy. He's Vice Chairman and Director of Research over at Ariel Investments. Ariel, by the way, has over $5 billion under management, and Charlie comes to us from Chicago. Charlie, great to have you back with us. It seemed like today Greece was a little bit more on the back burner because you had news from Ben Bernanke and some other things impacting the market. Should it be on the back burner, or we got to watch this very closely in your view?
Yeah, well, it was on the back burner also because there was no real news. All the stories that were out were unnamed sources expressing pretty vague opinions. So when we get some real news, I think it'll actually move things one way or another. It's an important issue.
What do you think is going to be the real news when it eventually plays out, Charlie?
What the package looks like. Is it just something that's a show of support, something that's kind of window dressing, or is it real aid that actually would help pay down some of the near-term maturities? If we aren't seeing that, if this is just a Band-Aid and this looks like it's a problem that's going to be continuing, I think it could put pressure, particularly on financials. What
about contagion? That's a real issue here as well.
Yeah, nobody at this point on Wall Street believes in contagion, believes that thing can be contained anymore. We all heard about how subprime was going to be contained, and how did that work out? So at this point, people are pretty much convinced that a big problem tends to spread.
Let me ask you, because you do point out that everything is linked. I'm just looking at my notes here. I mean, in terms of contagion, Charlie, I mean, how much should we be concerned about, not necessarily sovereign debt outside the United States, but our own here domestic sovereign debt, if you will, be it from the federal government or at the state level?
Look, different countries are in different shape. This is going to impact different people. But as your reporter just mentioned, U.S. banks probably have north of $100 billion of exposure to Greece. If you add up all the exposure to the unfortunately named pig countries, then it's probably something a couple $100 billion. The losses are not going to be big, but they're going to be something that people are going to focus on. So the short term is, in my view, this is not going to go away off the papers for at least weeks and maybe months.
But it's manageable in your view?
Yeah. Sure, but again, the way these things tend to work is somebody loses money and takes a hit, and so that institution becomes a little weaker, and somebody else that's lent them money takes a hit. These things do tend to not be contained in one small box.
Let me also ask you about Ben Bernanke today. Charlie, as you know, he made some comments, plans to potentially raise the discount rate. What was your interpretation of what he had to say today? He didn't say it officially. He released, of course, his comments.
Right. I mean, Fed watching, people use a microscope on every word, every comma. Did they change any phrase? And I guess I came away today thinking there really wasn't much of a change. So maybe you could argue this was a little bit more hawkish, interest rates possibly going up, which is, of course, good for the dollar, not so great for oil and materials. But it was an awfully small change, if any. Well,
do you feel like, Charlie, at this point, maybe the Fed doesn't quite know how it's going to unwind this?
Yeah, I think that's well put, Carol. I think if they know, they're certainly not telling us. And so people are looking for an explanation of how we're going to get out of this. And I think more and more the time goes by, clearly we're going to be in this for a long period of time, which just means a big balance sheet for a long period of time. Right. Probably going to have relatively low interest rates for a long period of time.
Long period of time means what, Charlie, in your world? Is it 6 months, 12 months?
Well, yeah, I mean, I personally would predict that we would have some kind of uptick in federal short-term rates by the end of this year, but we're not going back to 5% anytime in the next 3 years. So I think this is going to be a period of lower rates for 2 and 3 years going out.
What does that mean for the backdrop for the equity market in your view?
Well, the good news is that when you would increase rates would be when the economy was getting stronger. If employment looked better and Bernanke thought he could raise rates, it would really be that rates would go up after the economy gets stronger. So probably the stock market can do okay in that time period. But the fact of the matter is people have a lot of money right now in very short instruments that are earning almost no interest rates. And I think money will move to safer investments if you can earn anything. If you can earn even 2 or 3% on money markets, people move money there.